This is Optimal Finance Daily, episode 920. Long-Term Care Insurance is a Waste of Money by Mike Ballew of EggStack.com. And I'm Dan, your host and narrator of some of the best blogs on personal finance. Hope you're having a great day and that you've had a great week so far. Before we get to our post from Mike, I want to thank creditrepair.com for their support. It's not just their name, it's literally what they do, and it's more than a one-time credit repair. CreditRepair.com understands that credit scores are a lifestyle. We all deserve an accurate and fair credit report, so let CreditRepair.com help you out. They work with you to check, challenge, and ultimately change your credit score. Repairing your credit can be hard. Calling CreditRepair.com? Incredibly easy. Call a credit advisor today and let them help you rewrite your credit story. Head over to the link in our show notes to sign up today for a free 15-minute credit analysis. Now let's get right to it as we start optimizing your life. Long-Term Care Insurance is a Waste of Money by Mike Ballew of EggStack.com. The case for long-term care insurance goes something like this. 70% of all Americans will need long-term care at some point in their lives, and the average cost for a year's stay in a nursing home is $100,000. Sounds pretty convincing, right? So why is this article entitled Long-Term Care Insurance is a Waste of Money? Listen on, and you'll find out. Not everything is as it seems. Take that statistic, 70% of all Americans will need long-term care at some point in their lives. Really? 330 million people call the U.S. home, yet only 1.4 million live in nursing homes. That's less than 1%. So what gives? Are they lying to us? How can you explain the drop from 70 to less than 1%? To answer that, a bit of insurance terminology is needed. ADL is an acronym for Activity of Daily Living. ADLs are everyday tasks, like taking a shower or brushing your teeth or getting dressed. Disability is measured by the number of ADLs that a person cannot do. Many people only need help with one ADL. When that's the case, more often than not, the long-term care is provided by a family member. The trouble is, the insurance industry includes that care with the care of those living in a nursing home. The fact is, the majority of long-term care consists of free in-home care provided by a family member. Less than 40% of those in need of long-term care live in a nursing home or assisted living facility. That is the lion's share of the explanation. The rest is the duration of the average nursing home stay. Turns out, it's not very long. The majority of nursing home stays are less than 90 days. People either get better or they don't. If they get better, they go back home. If they don't, well, that's the other way to leave a nursing home in less than 90 days. Only 25% of nursing home stays last more than a year, and only 5% last more than 2 years. Long-term care insurance. The cost of long-term care insurance increases with age, as does the chance that your coverage will be denied. This paradigm forces people to get long-term care insurance when they are in their 50s, which means they will spend decades paying for it before they might actually use it. And it's not cheap. The average premium for long-term care insurance is $300 a month. Premiums rise each year, and it's not uncommon for people to drop their policy altogether. In fact, 10% of policyholders cancel their long-term care insurance in the first year. Like whole life insurance, if you drop your policy, you don't get any of your money back. All the money you paid in is just a big, stupid waste. If you have long-term care insurance and you actually need it, there's a strong possibility that the insurance company will deny your claim. Most policies have multiple exclusions, including a 90-day exclusion period. As mentioned, most nursing home stays don't last 90 days, so you get nada. So do I need it or not? We just pulled the rug out from under the case for long-term care insurance, namely that 70% of all Americans will need long-term care at some point in their lives, and the average cost for a year's stay in a nursing home is $100,000. The number of people who need paid long-term care is significantly less than that 70% figure, and those who are institutionalized probably won't stay 90 days, much less a year. So is everything associated with long-term care insurance just totally asinine? Not necessarily. The road to hell may be paved with good intentions, but we believe the underlying intent of long-term care insurance does have merit. Consider this. The odds that your residence will be damaged by fire are only 1 in 200, yet we all have property insurance. What does that say about insurance? It says the decision to buy a particular form of insurance is based on the possibility that something will happen and the extent of the consequences if it does. Losing everything in a fire is simply too big a risk to take, plus the mortgage lender requires it. It boils down to this. Is it possible that you or your significant other could spend years in a nursing home and completely wipe out your savings? Yes. Then something needs to be done about it. A better way. You can pay an insurance company $300 a month for decades and hope they'll be there if you ever need them, or you can insure yourself. If you are unfamiliar with the term self-insured, it means to keep the money and invest it rather than giving it to an insurance company in the form of premiums. Let's look at an example. On his 55th birthday, Bill turned his back on the insurance industry and decided to become self-insured. He started putting $300 per month in an investment account that earns a modest 6% return. Over the course of 30 years, he faithfully contributes to the account and it grows to $375,000. At the age of 85, Bill falls gravely ill. With inflation, that $100,000 figure we've been using for a year's stay in a nursing home has grown to $200,000. Bill's self-insurance plan will pay for almost 2 years in a nursing home. The odds that he will stay longer than that are only 1 in 20. If you forego long-term care insurance, it is highly unlikely that you will end up on the streets. Medicare pays the first 100 days of long-term care, and after that, if you burn through your savings, you'll qualify for Medicaid. Medicaid pays for long-term care indefinitely. As for the one left behind, there's Social Security and hopefully a paid-off mortgage and life insurance. Bottom line. If you get long-term care insurance, odds are you will never use it. You will never need it, and if you do, there's a strong possibility that the insurance company will deny your claim. Over the course of decades, it is entirely possible that your insurance company will go out of business. The financial meltdown of 2008 saw titans like Bear Stearns, Merrill Lynch, and Countrywide get tossed onto the trash heap of history. Here's the bottom line. You're better off insuring yourself. Sock away a load of cash, and it will be there if you need it. If you don't ever need it, you can give it to your heirs. Try doing that with long-term care insurance. We leave you with one final thought. This is definitely something you want to discuss with your spouse or partner. He or she is the one most affected by insurance decisions. If you never have this conversation and a time comes when you need to tap your self-insurance fund, you are going to get a big "I told you so." I told you we should have gotten that long-term care insurance. Do yourself a favor. Discuss this with your significant other and get on the right track. You just listened to the post titled "Long-Term Care Insurance is a Waste of Money" by Mike Ballew of EggStack.com. And thank you again to CreditRepair.com. You can get a free 15-minute credit analysis with the link in our show notes. CreditRepair.com can help with collections, late payments, charge-offs, liens, bankruptcies, and repossessions. Millions of Americans have inaccurate or unfair negative items wrongfully hurting their score. This is something we hear about on this show frequently, and recently, in fact. And there's a reason they're called CreditRepair.com. It's literal. They make it easy to stay connected to your credit repair journey and help achieve the goals you've set in the process. Previous members have seen an average 40-point TransUnion credit score gain during 4 months of membership. Repairing your credit can be hard. Calling CreditRepair.com? Incredibly easy. Call a credit advisor today and let them help you to rewrite your credit story. Head over to the link in our show notes to sign up today for a free 15-minute credit analysis. And that's going to do it for another week here at Optimal Finance Daily. Hope you have a great weekend. Thank you so much for being here this week and for being a subscriber. And I'll see you right back here on Monday, where your optimal life awaits.